Hi, this is Nick Shepherd, the author of How Accountants Lost Their Balance. The subtitle is How the Profession Has Drifted Away from Reality and Must Adapt to an Intangible World. Maybe kind of a controversial book for a lot of people in the accounting profession. But the point I'm making in the book, and the thing I think we need to think about, is that some of our approaches to counting are somewhat out of date based on the reality of the economy we live in today. People in particular are certainly a significant cost to an organization, but in terms of cash flow, that cash is going into not necessarily paying people to produce products and services anymore, but to create the infrastructure and the capability and the capital for the organization to operate. If we look at the delivery of products and services in a lot of cases today, the delivery of products and services is all done through technology. And so the people that are working behind the scenes are working on building the capability of that technology to deliver those products and services over the long term. In effect, they're developing and implementing the machines and equipment which in the manufacturing age were used to create the products and services. The processes and capabilities that we have today, both the manual processes and the computerized processes, are in fact the tools and equipment that we use to deliver our products and services for the future. The accounting profession is beginning to come up to recognize this issue and move towards an improvement. There's a term being used called the creation of future-oriented intangibles. In a lot of cases, the problem is that many of these things that money is being spent on are not allowed to be recognized as assets under accounting rules. So the expense that goes to investing in creating this is all written off annually as part of an operating cost. And in fact, what is really surprising, if I put money into a business, and let's say I put $1,000 into a business and the owner goes out and spends $1,000 on a machine, I can still see where my $1,000 is. It's sitting on the balance sheet as an investment in a piece of equipment. And if that piece of equipment is going to last 5 years, I essentially take that charge of $200,000 a year or $200 a year over the life of that piece of equipment. So I can see where the money went. But if you look at the money that's spent on creating these future-oriented intangibles, the money is considered a one-time expense. It's written off against revenues that are being generated in the current financial period. That means that in effect, if I use all of that money in the first year, I've completely depleted the investment that I had. And according to the financial statements, I have a loss created by spending all that money because it hasn't been used to create an asset. There is nothing on the balance sheet. And yet, in fact, where that money went was to build the capability to operate the business into the future. So it's no wonder that we have this growing gap in the marketplace between the economic value or the market value of an organization and the accounting value. The accounting value says if you spend your money on building these future-oriented intangibles, it's gone. You can't see it. It's disappeared. Worse than that, of course, when we now rely on audit statements to say that our organization is an effective going concern, well, all the auditors can check is that that money has been written off. There is no asset to go and verify. And so this provides somewhat of a misleading picture to investors because they can't really see, number one, where did the money go? Where did my investment go? Where is it represented? There is no asset on the balance sheet. It's been written off. And in fact, by writing it off, it's depleted my equity. So, hey, where's my money gone? And the other thing is, not only do I not see where the money went, it's all buried in part of my operating costs, nor can I see if management is doing a great job at sustaining and protecting this money, this investment that was used to create things for the future, because there is no asset to verify. All that an auditor is going to check is that the income statement was correctly prepared and the balance sheet was correctly prepared and the cash flow statement was correctly prepared. So there is no financial reporting, there is no audit reporting on the creation of these intangibles, which form the basis of how companies operate today. It's a real challenge. And we have to look at this. We have to address it in the same way that many of the accounting standards were developed after the great crash in the 1929, 1930 period. Many of the accounting standards we have today came about because the investors were saying, where did my money go? I want more transparency. I want more accountability. I think today we're in exactly that same position. I don't think necessarily we need to change accounting standards to do this. I think what we do need to do is to provide better transparency that, as they say, follows the money. Where did the money go? So that essentially investors have a better picture of where their money went. And we have some way of management commentary, possibly talking about what is the condition of these intangible assets that we've created that our whole business capability depends on in the future years. So that's the reason I wrote the book. I wanted to have a bit of a wake-up call, even though maybe some people disagree with it. We really have to look at this particular issue because we live in an intangible world, and we need to be able to do a better job of answering the question, where did the money go? Hope you buy the book and enjoy it. And we are doing continuing work in this area of intangibles. So, as they say, watch this space. Thanks for watching. Bye.